Hey everyone, welcome back. Imagine this, you're at the grocery store, scanning prices, trying to make your paycheck stretch just a bit further. Sounds familiar, right? Well, you're not alone. Today, we're tackling a topic that touches the wallet of every price-conscious family out there, the buzz around interest rate cuts. With the Federal Reserve signaling changes on the horizon, we're here to decode what this means for your day-to-day budgeting, your loans, and your money. We'll explore how these anticipated rate cuts could ease your financial burden and offer strategies for navigating the shifting economic tides. First off, let's get into what's been happening with interest rates. Recently, the Federal Reserve decided to keep the benchmark federal funds rate steady, which is pretty high, historically speaking. But here's where it gets interesting for us. They're planning on cutting rates 3 times this year. That's right, rate cuts could be on the way, and that's big news for anyone with a loan, credit card debt, or savings account. It means borrowing could get cheaper, and managing debt might become a bit easier. Now, you might be wondering why the Fed would cut rates. It all comes down to inflation, basically, the cost of living. Inflation's been higher than anyone likes, which makes everything from groceries to gas more expensive. The Fed's hoping that inflation is now slowing down, making life a little more affordable for all of us. But, and this is important, inflation has been pretty stubborn. Despite some cooler months last year, prices have started to climb again early this year. The Fed's still optimistic, though, expecting things to smooth out and inflation to drop closer to their target. This is crucial because high inflation can eat into our budgets, making it harder to afford the basics. For those of us keeping an eye on our spending, the prospect of rate cuts has a few implications. For starters, if you're looking to buy a home, mortgage rates could come down, making monthly payments more manageable. And if you're carrying debt on credit cards or considering a personal loan, lower rates could mean lower interest payments. But it's not just about borrowing. The economy overall is showing signs of resilience, with growth expected to pick up. This could mean more job stability and, hopefully, better wages down the line. Yet, there's always a balance to strike. The Fed's aiming to cool off inflation without slowing the economy too much, which is a bit of a tightrope to walk. So, what does this mean for your money and wallet? First, it's a good time to review your financial plans. If lower rates are coming, you might find opportunities to reduce debt costs or maybe even lock in a lower mortgage rate. And, while savings account interest might dip a bit, the overall benefit of potentially lower inflation and borrowing costs could outweigh the negatives. So, as we look ahead, it's all about staying informed and making savvy decisions. The economic landscape is always changing, and being proactive about your finances is key. Keep an eye on how these potential rate cuts unfold and consider how they could impact your budget and savings goals. If you're navigating these financial waters and looking for ways to make your money work harder for you, you're in the right place. Please subscribe for more updates and tips on managing your money wisely. Remember, we're all in this together, navigating the ups and downs of the economy. See you next time.